everyone, I am Princess Eliza Delos Reyes, and today we will be discussing a four-part comparative financial performance between the PNB, known as the Philippine National Bank, and the PSB, known as the Philippine Savings Bank, covering the fiscal year 2022 to 2024. This involves four major analytical components. The first one is the profit margin comparison. It evaluates earning capacity and net income efficiency. The second is the ROA and the ROE analysis, which measures each bank financial efficiency in converting assets and equity into actual profit. The third is the revenue trend assessment, which review year-to-year movement in top-line revenue to determine growth direction and market performance. And lastly, or the fourth is the financial risk analysis, which identify key risk exposure such as liquidity risk, leverage pressure, profitability constraint, and the credit-related vulnerabilities. Through these four financial dimensions, we are able to gain a clearer and more meaningful view of each bank's overall performance profile, not only in terms of profitability, but also in their operational efficiency, growth trajectory, and exposure to financial risk. This integrated approach allows us to determine how each institution positions itself in terms of earning strength, sustainability, and financial stability over the 3-year period.
Data number 1. Good day! In this topic, we will briefly explain the comparative profit margin performance of PSB versus PNB for fiscal years 2022 to 2024. In accounting, the profit margin ratio is profitability indicator that measures how much actual net earnings remain after paying all operating expenses, interest, and other charges. Higher profit margin means stronger earnings efficiency per peso of revenue. Thus, based on the data, PSB posted an average positive profit margin of around 0.2947. This means PSB is generating residual income, meaning its revenue sufficiently covers its total expenses. This reflects strong profitability and operational efficiency. On the other hand, PNB reflected an average negative profit margin of negative 0.4886, which indicates operating losses, meaning its expenses exceeded its revenue capacity. Therefore, from a financial accounting perspective, PSB is clearly the more profitable entity between the two banks for year 2022 to 2024.
And for our second topic, we will explain the comparative financial efficiency of PSB versus PNB, specifically focusing on return on asset and return on equity performance in 2022 to 2024. But first, let us define what is ROA or return on asset. This measures how effectively a company uses its all asset to generate net income. Meanwhile, return on equity or ROE measures how well a company converts shareholders' equity into actual earning. These ratios are core indicators of financial efficiency. And based on the 3-year comparative data, PSB consistently recorded higher ROA and higher ROE in all fiscal year presented. This means that PSB are more efficient in utilizing assets to produce profit and more efficient in generating returns to equity holder, maximizing shareholders' value. And to conclude, PSB exhibit a stronger internal profitability and better capital utilization. This shows that PSB has a stronger financial leverage and overall better earning efficiency. And based on the efficiency metrics, PSB outperforms PNB.
Good day! I am Esteleydes.
So now, let's proceed to data 3. In this explanation, we will analyze the revenue trend performance of PNB and PSB covering fiscal years 2022 to 2024. From the data presented, both entities demonstrated an upward trend year over year. In accounting terms, this reflects a positive top-line expansion. Year-over-year growth indicates that the companies are continuously increasing the revenue-generating capacity. PNB posted revenues of 52,079,268 in 2022, then increased to 57,360,052 in 2023. And further rose to 59,779,488 in 2024. This consistent upward movement suggests improving operating capacity and stronger earning potential, showing that PNB is gradually expanding its revenue base. Similarly, PSB showed revenue growth from 15 billion, 20 million, 371,762 in 2022 to 15,144,916,174 in 2023 and 15,318,476,596 in 2024. These upward trends reflects stronger customer transactions and increasing demand for PSB's financial services, meaning its core income sources. In conclusion, both PNB and PSB experienced positive revenue growth for 3 consecutive years. From an accounting perspective, consistent top-line improvement supports a favorable outlook in terms of ongoing operational stability, improved revenue generation, and sustained earnings capacity.
And to further discuss our last topic, we should analyze and evaluate first the financial risk exposure of PSB versus PNB based on the dashboard presented. And to start, PNB shows significant liquidity risk. The weak current ratio indicate that current asset may not be enough to cover short-term liability, signaling poor working capital management. In addition, PNB also reflect higher leverage exposure, meaning a larger portion of its capital is financed by interest-bearing liability, which increases solvency risk. The thin net profit margin also suggests weak earning quality and limited capacity to generate retained earnings for future capital buildup. Meanwhile, PSB is more profitable compared to PNB, but it also still carries certain risk factors. The indicator reflects pressure on profitability due to modest or declining operating margin. This could be driven by increasing operating expenses or reducing pricing power. PSB may also face credit risk exposure, which is common in banking, such as slower turnover of receivable or potential loan impairment that could weaken revenue performance. In conclusion, PNB demonstrates stronger liquidity and solvency risk exposure, while PSB, despite better profitability, show risk in sustaining its margin performance. Both banks still require strategic financial risk management to protect earning capacity over time. That's all. Thank you.